वेलकम टू वेब क्लास। वेब क्लास में आपका स्वागत है। वी आर इनटू ट्रेनिंग एंड डेवलपमेंट ऑफ सॉफ्टवेयर फॉर म्यूचुअल फंड डिस्ट्रीब्यूटर्स। आज ट्रेनिंग के बारे में बात करना है। वेलकम बैक। टुडे वी शैल बी डिस्कसिंग अबाउट दिस इज द फर्स्ट चैप्टर ऑफ द फिक्स्ड इनकम सिक्योरिटीज। नाउ इन दिस चैप्टर we will largely concentrating on the different types of bond and with small introduction of bond. Bond market and all will follow little later, but what is the bond, what are the special features of bond, and then the different types of bond in details. That is the only limit. This much only we are going to discuss today. Now first of all, when we say bond, bond can be known by many other words, like you can call them bond, you can call them fixed income security. You can call them by something like loans also, fine. You can call them by obligation also. Obligation is a very important word. When we say equity, remember we call equity with the word called ownership. Equity is a type of capital that gives you ownership. Similarly, bond is another type of capital that gives you an obligation. So obligation should have a timeline, obligation should be between two parties. So that is what becomes the very simple small definition of a bond. Now if someone asks you what is a bond, bond is an obligation, there is a lender, there is a borrower. So every bond, every fixed income security shall be having a lender and a borrower, no, and they will have a defined means predefined, pre-announced, defined time period. These are the special features and the definitions of a fixed income security. So they have a defined time period and they will have a something called return. Now return is basically known by the word called yield. So I am writing here for convenience purpose the word yield. Now yield has many a variant. We will discuss this in the coming class, what actually you mean by the word yield, different types of yield and how they are relevant to us in our study and all. That will come in the second class, it could be in the third class. So fixed income securities are nothing but a contract. It's a financial contract. So I write here financial contract. It's a financial contract. No, financial contract between lender and borrower for a defined period, where borrower is raising capital from the lenders and then they promise them a fixed or predefined return. I am using the word fixed or predefined return. So this is very careful over here when we go into the details of that. That's the basic definition that you can tell to anyone who is asking for the definition of a bond. Now we are largely concentrating different types of bond. Bond can be of any type. There could be any number of bond that we need to know. Fine. So let us figure out how many different types of bond that we can make out today. Fine. Let us see. The most important that we know about a bond, that a bond will pay you return in the form of a coupon. So I write here that bond can be having a zero coupon bond. Means a bond has not paid you any coupon, but bond is paying you all the return in the form of capital gain at the time of maturity. So when we say defined time period, you look at the lender borrower defined time period. No, that defined time period means there will be a maturity date. So zero coupon bonds are basically, they will not pay you any coupon and then they will be paying you all the gains, that is the yield, that is the return, in the form of capital gain at the time of maturity. This is a kind of bond that is very, very popular. It's also called as a deep discount bond. So for a convenience purpose, I am writing here deep discount bond. No, deep discount bond is also to be known by the same word. Fine, deep discount bond. Okay. So then comes, if you have a deep zero coupon bond, then you can also have a coupon bearing bond. So you have another bond where you get the coupon. So coupon are coming to you. This is predefined. The first question that comes to the mind, who decides the coupon? Who decides the coupon? Whether this is the issuer or the RBI or the SEBI or the market or the issue managers, who decides the coupon? See, coupon is decided by the issuer and yield are decided by the market. This sentence has got a lot of meanings, lot of explanation. In a class that is going to come in the next, we shall be discussing about how we say that yield is decided by the market and coupon is decided by the issuer. No, that's very important. It will come a little later. So you have a zero coupon bond, you can have a coupon bearing bond, you can have a fixed coupon bond. Means I decide to give you fixed rate of coupon. You can have a fixed coupon bond. No, spelling and a fixed coupon bonds. No, and then you can also have a floating coupon bond. Floating coupon bond where the the return will be basically aligned with certain underlying, certain benchmark. Now, if I ask an example, just think on that, an example that comes to your mind, where your coupon is not fixed. It is not fixed in a sense, it is a predefined but not fixed. Predefined means you know how they are going to pay you, but it is not fixed. So they are predefined to be aligned in line with something called, let us say, inflation index bond. In that case, the bond coupon shall be getting paid to you aligned with the underlying inflation. If inflation goes up, coupon goes up. Inflation comes down, coupon comes down. No, so that's a floating coupon. Very, very important and very, very important. Now, if you go beyond this, then two bonds which is in form of coupon also, which is quite popular, and one is called a step-up bonds and one is also called a step-down bonds. Now, here in case of a step-up bond, what happens? No, the coupon keeps going up gradually. Whereas in a step-down bonds, initially the coupon will be very high, but overall the coupon will be coming down slowly. First year coupon could be 7%, then 6.5%, then 6%. So coupon shall be coming down gradually. It is arranged in a manner, it is structured in a manner that you can align to have like that, right? So you can have these type of different type of coupon bonds that gives you a lot of understanding about. So bond can be defined like that also. Now, if you say based upon the maturity, this is based upon the coupon, different types of the things that we discussed. Based upon maturity, you can say that bonds are also short-term in nature. Short-term bonds, we can call them like a money market instrument. Now, these instruments are for less than 1 year. Now, there are a lot of bonds like that. You can say repo bond is there, CBLO, and a collateralized borrowing and lending obligation issued by clearing corporations. No? So you have a CBLO bonds, you have a repo bonds. Then in repo also you have different types of repo. Fine. So repo bonds, CPLO bonds, then CP, commercial paper, certificate of deposits, short-term bonds, call money market bonds also. So these are the bonds that basically are the money market instruments of less than 1 year maturity. So within that money market instrument, something called, there is also one word called notice money. Notice money are those bonds where actually you are supposed to pay back, means a borrower is supposed to pay back to the lender at a 1 day notice. Notice bond will have a maturity up to 14 days only. No, that is also very important word, and in case of short-term bonds, this is also taken to be a very, very important bond as such. Fine. Then you have a medium-term bond, you have a long-term bond. Let us say medium-term bond. Medium-term bond means could be around say 2 year to 5 year maturity, 2 year to 6 year maturity, something like that. And then beyond that, if you go beyond that, bond can come to the say level of 20 years, 30 years also. Government security bonds in India are issued up to 30 years. No, normally we say 10 years is quite popular, but you can come with a very, very long money, very, very long bond. So 10 years, 20 years, 30 years. So these are the long-term, medium-term bond and long-term bond. So you now know so many bonds based upon different type of maturity. So I say long-term bond. Now there is one special segment of bond which has got a very unique definition attached to that, unique properties attached to that. That's a perpetual bond. This is only one bond that I can remember, that I can identify, where the maturity is defined in a manner that it will never be getting matured. These bonds are like an equity maturity. It never gets matured. It keeps giving you interest for a long and very, very long period of time. No. So this is a perpetual one, not very popular and not often sold in the market as well, but still this bond is there in the market and quite substantial. Lot of a part of a bank capital is also coming in the form of a perpetual bond. That's quite relevant over here. No? So you can see, so this part of the bond is designed to follow something like, you can say coupon. No, I put it into one color. You can see it all with different kind of coupon, and these are based upon different type of maturity that you can think about a bond. Now let us proceed ahead. Now, very popular bonds in India are convertible bonds and non-convertible bonds. Very, very popular. No, these bonds on maturity, they are predefined. They are predefined. So these bonds on maturity, they are converted into equity. Predefined rates are there, predefined conversion factors are there. Based upon that, if you opt for a convertible bonds on maturity time, it will convert into equity. It will not pay you the payment, but it will convert into equity at a predefined price and predefined conversion rate. Quite popular at some point of time, but thereafter it is not having so much of popularity right now. But of course, it's a point to be understood that this is a convertible bond. And then if it is a non-convertible bond, in that case, though, you are going to get back the money as you have proposed, as you have been planned out of that. Quite popular. Then if you go beyond that, then we can come across something like secured bond and not an unsecured. Not secured, not unsecured bond. Unsecured bond. Another important bond. This is to be considered. See, a secured bond has got always an underlying collateral. Secured bonds have a underlying collateral. For example, if I give you something very, very popular secured bonds example, then housing loans are secured bond. The underlying papers are with the lender. They keep the money with them. No, they keep the papers with them. Motor vehicle loans. Bank will collect your papers of motor vehicles. Similarly, your repo loans, your CBLO loans. These are the secured bonds. But majority of the bond, if you see, and even if you go across to the banks, no, then banks will also ask for pledged amount, security amount, some collateral kind of thing. So if that is happening, then that's also a secured bond. But if the bonds has got like credit card bonds, no, these are, credit card loans are nothing but unsecured. Personal loans are unsecured. A lot of loans that is in the industry are also unsecured in the nature. So this is also very powerful loan, and this is very, very visible in the market. Now, let me put it into different color now. So, okay. So secured bond and unsecured bond. Now, if you go beyond this, then let us come to say something like a sovereign bond. This is very, very popular bond for any country. Any country, it's a very big subject. Why government is going to borrow? Yeah, government needs capital. They can borrow within the country domestic currency. If they borrow outside, that will be foreign currency. We'll discuss this little later as another type of bond. Fine. So you will see when government is borrowing from market, so those are called sovereign bonds. And you have example of treasury bills. You have example of GSEC, government security. You have example of state developmental loans. Earlier they were called state security, state GSEC, but nowadays it is called state developmental loans. No, so you have sovereign bonds. These bonds are supported by the government commitment to pay you back. Government does not require to earn and then to pay you back. Government has got two unique rights. One right is to charge taxes from you. They will charge taxes from you, and they can also print money. Both the rights are called sovereign rights. We individually cannot collect tax from you or can print money. So this is sovereign right. Therefore, these are protected by the return on treasury bills. GSEC and state developmental loans are protected through the budget of the government. No, and budget has a provision of your loan collection. That's the tax collections, and also the printing of money, deficit financing. You understand this, no? So sovereign bonds are of this nature, where treasury bills, GSEC, and state developmental loans are. But other than sovereign bonds, you will say there are other bonds like corporate bonds. Yeah, corporate bonds can come in different form, and corporate bonds are also known as rated bonds. Rated bonds. Why? Because they are to be compulsory rated. Rating for what? To measure the ability of a borrower, that is a corporate, to pay back to the lender, that is an ordinary person like us. No. So every corporate bond shall be getting rated. They all carry credit risk. We'll discuss credit risk in another chapters, not now. So corporate bonds are very, very popular, quite big. And I will say to an extent, any country, if you have a very, very healthy corporate bond, that means you have a very healthy capital market, because ultimately the vibrancy, the liquidity in markets should come from corporate bond, not only from the sovereign bond. Sovereign bond, of course, will give you a lot of liquidity, because ultimately it's a government guaranteed, government powered, government has sovereign rights, so they are able to do that. In fact, there is one more word that attests to the sovereign word, is that they are also called dated security. No, dated security, that's another word that is also security. All right, security, fine. SECURITY, security. No, they are also called as a dated security. So corporate bonds are known as rated bonds, and they are quite popular. And this is required for any vibrant capital market in any country in the world. Now, corporate bond can come in any form. They can come in a very good kind of a corporate rated bonds like AAA, AA, and all. No, they are also called investment grade bond. Investment grade bond. Now, you see, different industry has got different kind of investment grading. Like mutual fund, they will be investing up to B securities. PMS can go into little lesser than that. AIF can go into little lesser, depending upon the regulators' provisions. How have they allowed you to invest in different kind of bond and all? So they are also to be classified as an investment grade. So certain industry are little careful, so they will be taking only certain grade of bond, and below that is not permitted into that. So they are also are into different kind of classification of investment grade bonds. If you go below that, it can come into something like junk bond. Junk bond means bond which is very close to be called default. It's not defaulted so far. It's a very poor rating and very high yield. They carry very high yield. Now the word yield and rating shall be getting explained a little later, but just for the understanding purpose, they carry a lot of credit risk. The chances that they will pay you back are always compromised. No, if they pay you back, they will give you huge return, in a sense, really huge return, because they carry high yield. Yield is return. Fine. So junk bond, if the bond actually is not able to pay you, they can convert into also default bond. So very important bond. So if you go into this area, so you have a sovereign bonds, corporate bond, investment grade bonds, junk bonds. These are the very important areas. So let me put into one color for them also. Now, bonds are still not endless. No, you can come across so many bonds, but not very difficult to remember. Any kind of discussion that you go across, and you will find these bonds happening there. No, in fact, if you just think beyond this, not very popular Indian context. No, beyond corporate bond, there is one bond that is coming up quite popularly in the Western country, and we did try in our country in couple of municipalities, municipal bonds. I could just able to get in a flash. So municipal bonds are issued by municipality to meet their capital requirement, to run their local affairs. Not very popular in India. Reason being that municipality in India does not carry that kind of credit worthiness that people are going to deposit money with them. No, that's a very big issue over here in India. But they mostly depend on the government aid, they do not have their own resources where they are able to raise the resources and be so credit worthy that we feel proud to give you money. No, I think one or two municipalities in India, probably Ahmedabad and I think Indore, I'm not very sure on these, but these are the municipalities who tried it, and then I think somehow it is not in practice in India, of course. No. So if you go beyond this, then one important word is the domestic currency bond and external currency bond. External currency bond, that is also very important word. External currency word. So this is also very important word. If you are borrowing in the Indian rupees and then paying back in Indian rupees, that's nothing but domestic currency bond. But if you are borrowing in say foreign currency like any currency, dollar, pound, euro, anything, and then pay them back in their currency. So this is a external currency bond, and an external currency bond, not work currency bond, and this is quite popular. It's required because you need foreign currency at some point of time. So if FDI comes in the form of equity, if FI comes in the form of equity, that's a fine. Otherwise, sometimes we have to raise capital, and a lot of instruments are there. Popular instruments are there, like external commercial borrowing (ECB). It was the oldest bond of this category and very popular over there. Then you have a FCCB, foreign currency convertible bonds. This is also quite popular at some point of time. It's something like very close to be called a convertible bonds. Very convertible. Convertible bonds also converts into equity instead of paying you back. FCCB are actually converting into equity, domestic equity shares, but not actually paying you back. So foreign currency convertible bonds, quite popular at some point of time. Then one variant of this FCCB came in the form of FCCE, foreign currency convertible equity. You get the equity of your holding company, not the company which actually have borrowed the money from you. Very, very important. And then Euro bonds are very popular all over the world, very, very popular, because if you are raising capital from a country which is not the domestic country of that currency, for example, suppose you are raising dollar, not from America, from say Britain, from say Australia. So that will become Euro bond, prefixing with the local currency there. So this is also quite popular. Europe is a very big market for Euro bonds. And then if you go into one bond which has been recently very, very popular, not I will say very, but it is of course in use, Masala bond. Masala bond is where we borrow in foreign currency but pay in Indian rupees. No, that is a very important aspect. We pay. So in this case, the currency risk is actually not resting with us. It rests with the lender, not with the borrower. No, very, very important bond here. This is given a name like masala. Could be because of India we use masala, a lot of masala. So here we borrow money, here we borrow capital in the form of foreign currency and pay you back in the form of a rupee. So that becomes masala bond. I think the bond is becoming too long, no? So this is the different type of foreign currency, external currency bonds are there. Then if I proceed, then one important word that comes to my mind is securitization. Securitization, you must have heard of this. So securitized bond. So I will say securitized bond. This is one word which actually became very, very popular, securitized bond, not word, securitized bond. So this became very popular following 2008 subprime crisis in America. That was basically reason behind securitization, why this subprime crisis happened. We are coming up with one beautiful video on this, a small video on this about how this securitization happened, where it all failed and all. No, so there were different types of bond that you can come across. Some bonds are like, popular bonds are like mortgage-based MBS, mortgage-based securitization, or asset-based securitization, ABS. No, you have also PTC, pass-through certificates, different types of bond. Of course, the features of bonds will be same here. You have a lender, you have a borrower, you have a defined time period, but a structuring of bond is done in a manner that you can say that, yeah, this bond carries some different kind of meaning. We have credit default swaps are there, credit default options are there. So many bonds are there. So these bonds are designed, they are created, they are securitized, they are very, very complex bond. Not for ordinary persons, I will say. This is basically for institutions, and they carry a lot of risk. A lot of hidden materials are there. These are not very transparent bond. These are not very transparent bond. These are little opaque in nature. So we suggest it to understand this more from the perspective of that you are an investor in an institution, and institutions is going to borrow, examine, and then earn from these bonds. No, so that's a very, very important bond. Now, very close to this bond will be something that is used in the derivative market. You have a callable bonds. Callable bonds is nothing but a kind of a forward bonds where you have a promise that the issuer can call it back at any point of time. If the interest rate comes down, issuer will like to call it back. There are instances in India when interest rate started coming in 1990s from say as high as 18% to say 12%. No, it came down to 12%. So a lot of bonds were then called back by the issuer. So these bonds are also known as a callable bonds. And similarly, you have a putable bonds. So these bonds actually subscriber have a right to submit it in case of interest rate goes up. Like fixed deposit that we have a right of putable. Right to sell is called put. Right to sell is called put. So subscriber of a fixed deposits have a right to sell. Suppose interest rate, my old FDs are of a 7% and the new interest rate is 8%, then I have a right to go and surrender the FD, get back my money, whatever money is there, and then again rebook it at a higher interest rate. So that's also very, very important thing that is there. No? So these are the different types of bond, and if I can go on collecting some other bonds of this nature, then you can say some special situation, special types of bond, not situation, a special type of bond. It's relevant to any economy, like we have here in India tax-free bond. Now we have in India infrastructure bond, a structure bond. We can say like that. We can also say something like RBI bonds. RBI bonds quite popular in India. No, then you can also say we have PSU bonds. No, PSU bonds. So corporations. There are a lot of corporations in India. They also come with their deposit schemes, corporate bonds or corporations, no, they comes with this or deposit schemes like that. You can, these are not very independent or a very unique kind of bonds, I will say, but then of course these are in practice also, there is no doubt about that. So you can see so many types of bonds are there. Now, so many types of bonds are there, and bonds, all bonds have some underlying features. Almost all of them have same features. Same feature in a sense that, let me put it there in this color. Yeah. So same feature is that they all will have a one lender, one borrower, defined time period. They will have a defined yield. Defined yield. I am not saying fixed yield. You can have also variable return, floating interest rate or nothing, but they cannot have they have a defined yield but not fixed yield. Fine. And this is nothing but a kind of a financial contract. So very simple to understand, because all of them carry one kind of understanding. So very easy. In the next coming chapter, we will start understanding the different types of yield that they can generate and measurement of those yield. So yield is a very, very big subject, very big area. And if you have a yield that is return, then it will come with some element of risk. So different types of risk. So different types of risk and different types of return attached to this. We will have two classes on that, two separate classes on that, and then measuring the risk will be a separate topic for you to understand. And then there are some unique features of a bond, like bond immunization, non-parallel yield curve. So there are many features designed with the bonds. We'll see it gradually down the line. But before that, listen to this class again and again. Fine. Try to first familiarize with the different words and try to speak out. Listen to the video, pause the video, and then speak. If you only listen to me and do not speak, then you will get only 20% benefit. But if you speak more than actually what I speak with you 20-25 minutes, you speak with me 40 minutes. So after listening, pause it, speak, practice. After listening, pause it, speak, and practice. If you do this, this will really be a good benefit to you. Fine. So thank you. Thank you very much. You can visit us at our website WebClass.in or at our research website research.webclass.in. You will get a lot to know about mutual fund schemes research. We also develop mutual fund distributors websites, and you can see it on mfd.webclass.in. You can write to us at my mail ID sanatbharadwaj@gmail.com. You can also write at services@webclass.in. My number is 8910492919.